to get into multifamily.
Yeah.
So you're trying to get into multifamily shit.
Yeah.
Okay, so what did you just? So that's the book that you recently bought. You haven't started any investing yet, right?
I mean, I'm a homeowner. Well, no, I'm a
Okay.
home renter.
Credit card, so the rate is going to be a.
Okay.
Sorry,
So,
you started
Stephon, let me
dropping the
ask you
gems
this.
early, so I started recording because you already dropped it.
Oh,
We didn't even get started yet. You already.
We done started. We done already
I
started this
know.
thing.
Sorry, go ahead. About the
So,
HELOC.
yeah, the HELOC, because again, the knowledge of it, you know what I mean? If
Mhm.
you don't know something, you ain't gonna just jump. For me, I'm not gonna just jump and be like, oh, no, I need to know
Mhm.
more in detail.
Mhm.
So she kept telling me this. She was like, you don't pay it back until you actually use it. And like Stephon said, it's just like a credit card. So
Yeah.
is that correct?
Exactly. And then you're only, a lot of times you're only paying interest payments. And if you do pay the principal payment, you now have access to it. So if your payment is $150 and 140 of that is principal and the other 10 is interest, well, it'll be the opposite. 140 is interest, the other 10 is principal. You now have access to that $10 that you paid back. So it's kind of like a revolving door. Most of the time you're paying mostly just the interest on it. And what if I was in your situation now, right? I couldn't say this a couple of years ago, but now because your interest rate is so different from the 2s to the 7, I would take out the HELOC, hold on to it. When I'm ready to use it as a down payment on an investment property, I would use that HELOC as a down payment on the investment property, get the property rented out, see if I can refinance the investment property to pay my HELOC back. Now I have that HELOC money to use for the next property. And you essentially just recycle that money. You become your own bank. So instead of worrying about, oh, I have to save up for the down payment, you essentially have this HELOC that you can use for the down payment each and every time. And then the main thing is you have to make sure you have to buy a property that has some value add potential. So something that you can either fix up to make worth something, or you get it at a lower price, or you know there's development coming to the area. And if you know development's coming to the area, like, okay, this property is going to appreciate in value. So when I go to refinance, I can get my money back and pay off my HELOC. And then you use that money again for, like, my HELOC is like for 10 years. So I can just recycle that money for 10 years. I can buy properties in cash, refinance the properties, put a regular loan on it, and then pay my HELOC back, use that money for something else. So yeah.
She was talking pretty fast.
I'm sorry.
Did you get all that?
But how do you get a HELOC?
I'm so. Oh, how do you get a HELOC, Donna said?
Yeah.
You just call up your lender. I use Bank of America for mine because they were attached to my bank account, but a lot of lenders offer HELOCs. Steph, you offer HELOCs?
Yeah, most definitely.
Yeah. So you told the lender right here.
To a lender.
Yeah.
Just because you got your mortgage from whoever you got your mortgage from don't necessarily mean that's who you got to go to for a HELOC. You do want to actually shop around and see who got somewhat of the best rates, because they're not going to be too far off. You get what I'm saying? And also you want to take into consideration the time it's going to take to get the HELOC done. Some people move faster than others. So that all depends on who you end up dealing with. And all banks aren't created equal. So I can't really speak for every bank out there and what their processes is and how they're going to move when it comes to, getting things done.
Yeah.
So what is a good percentage we should be looking at as far as HELOCs?
So the thing with HELOCs is an adjustable rate.
Mm-hmm.
So just like I said, I use the analogy, just like a credit card, just like your credit card, you might have an introductory rate of something, and then it can ultimately adjust to the maximum of something else. You get what I'm saying? So a HELOC is no different. HELOC will be typically higher than
yeah. I was going to say that my HELOC is the prime.
FHA conventional loan is definitely going to be higher than that.
Mm-hmm. Yeah, so that's the idea, is to find a way to repay it back so you can continue to use it. Theoretically, you would use it for something more short term. So if you're buying something, if you can find a way to refinance and pay it back, or if you're flipping houses, flip it and pay it back, then it makes a lot of sense. Because my HELOC is set up so it's the prime interest rate plus 2%. So if the interest rates right now are 7%, then my HELOC is going to be 9%. But if the interest rates jumps next month to 7.5, mine's going to be 9.5. When the interest rates drop to 3%, mine's was 5%. So it just depends on, and so that's what he said. You have to figure out who has the best rates. How much above the prime interest rate the interest rate that's set by the, I guess, the Federal Reserve, are they charging above? Each bank is going to be a little bit different.
But it depends on your credit score too.
Yes, that's definitely a factor in what your rate will be.
Oh, okay. Well, let me ask you one question. You have information about HELOC? You said you.
Yes, I can
put some-
send you information after the meeting.
Okay.
If you just provide me with your email address, I can shoot something to your email address with a little bit more detail.
Okay. All right. Thank you.
You're welcome. Awesome. All right, you guys. So let's go ahead and get started because we have a lot to cover and we just started. But as we go through this thing, definitely feel free to stop, pause us, drop questions in the chat, and ask your questions because we want to ask the questions as they're coming up. But I definitely want to make sure that we can at least get through some of the agenda today. But you know what? If we don't, we just going to talk about real estate investing. That's the most important thing. So right now, hopefully you guys can see the presentation. Let me know if anyone's having problems seeing the presentation.
Sure.
You guys should see something that says how to get financing for your real estate investment.
Yes.
Awesome. Do you see my notes or you just see the presentation?
Just the presentation.
Hey, look at God. This is working. All right. All right. So how do we get financing through real estate? So first of all, I'm going to do some introductions for anyone that is new. So this workshop is going to be a little bit different than our normal meetups because we have a special guest here. So sometimes in our meetups, we just kind of talk about where everyone is in their process. But this one is really created to provide you guys with a lot of information about what your options are. So we're going to talk about some of the owner-occupied loans, which means you're living in the property. And so you're getting a loan based upon the lender saying that you have to live in the property, whether it's in one of the units or the basement or a bedroom. And then we're going to talk about a little bit about non-owner occupied loans. And our lender is going to go over a bunch of different loan programs that you guys can use. And you're going to use these loan programs, leverage them in order to meet your investing goals. All right. So don't think of it as like, oh, it's just a loan. Like, no, this is something that you're leveraging so you can get your investment goals. So really quickly, I'm Tiana Otley. I am a realtor with South State Dominion Realty, and I'm the certified real estate agent for the multifamily movement in this Washington, D.C. area. So I've been investing in real estate for 8 years. So I manage my own properties. I have 9 rental properties right now, so 3 in D.C. In DC, I have a Section 8 property and I have 2 room rental properties that I rent out to college students. I have 3 in PG County, which is where I'm from. In those properties, 2 of those are Section 8. The other one is a market renter. And then I have 3 properties in Baltimore, which is why I'm also active in the Baltimore group as well. So 2 of those properties are market renters, and the other one is going to become a travel nurse rental, kind of like midterm rental, midterm meaning like 3 to 6 month rental. So I've been doing this for a while. And I think the main thing is making sure you guys are working with people who have knowledge about this because it can be a scary game, but it's definitely worth it in the end. So some of the strategies that we learn about, the main strategy that we're learning about is how do you house hack, which essentially means we're taking a property that we live in and we're making money off that property. So house hacking can look a little bit different. So the main strategy that we're saying is like if you live in one unit of the property, you can rent out the other units to cover your mortgage and possibly to even make additional money, right? So the idea is I did that in my first house as a room rental. So I was renting out my rooms to college students. And then eventually I moved to the basement, rented out the upstairs. And then I finally bought a duplex where I lived in one unit and then rent out the other unit. So you can do it with a multifamily, a 4-unit, a 3-unit, a 2-unit. And we have some people who are just taking a regular house and renting out the rooms, which works really well in areas where you have like college students or hospital workers, people who don't need a lot of space. Some of the other strategies are to live in a property for a year. So you buy a property, live in it for at least 1 year, and then you rent it out. So you move out of the property, you rent it out. Or you can do a live and flip where you buy a property that needs work while you're living in there. Maybe the first 2 years that you're living in there, you're fixing the property up, and you would fix the property up to create value so that when you go to sell the property later, essentially you sell the property and get to keep that capital gain. So if you have owned a property and lived in a property at least 2 years of the previous 5 years, you don't have to, well, I don't know if anything's going to change with tax law, but right now you don't have to pay capital gains taxes up to $250,000 if you're single and up to $500,000 if you're married. So if I said, I don't want to have roommates, I just want to buy a house, need some work, slowly fix up the kitchen for 2 years and the bathrooms, I'm going to sell this property and I'm going to keep all this money, make $200,000 on it and not pay taxes. That's a strategy that I can use as well. And then there's just so many different options, whether or not you're doing short-term rental, which is kind of like nightly or even up to 30 days in some areas. Midterm rental is when we think about travel nurses who are renting a room for or a place for 3 months to 6 months. Typically, those are furnished rentals, so they already have furniture for them, or long-term renter. That can be a Section 8 renter, a market renter, meaning someone who's you just put it on Zillow and any old person reaches out and meets your requirements. So today we're going to talk a little bit about what are some of the owner-occupied loans, meaning you have to live in a property in order to qualify for that loan, right? And the reason why this is important is because typically those loans have a lower down payment. So I can get into a house that I'm going to live in for 3% down versus having to pay 20 to 25% down because I'm not going to live in the property. It's an investment property. So if it's $100,000 property, my down payment is 3% on a conventional loan or $3,500 on an FHA loan. For that same property, if I'm not going to ever live in that property, after my down payment on a $100,000 property is $20,000. So we're trying to figure out how to spend as little money as possible in order to get these properties, and then we're going to build from there. So tonight we brought you guys the lender who can talk to you guys about all this stuff. I'm going to let you go ahead and introduce yourself, the man, the myth, the legend.
What's going on, everybody? Thank y'all for coming on tonight. My name is Stephon Fields. I'm a mortgage loan originator. I've been doing this for almost 3 years now. I've had good experiences. I had bad experiences, but I like my job at the end of the day. Hopefully I can help you guys get through some of the questions and give you the answers you need in order to start your investment journeys. If you're already investing, then, hopefully I can provide you with some good information to kind of grow your investment business. So, if you all have any questions, I see the chat. I see a lot of y'all talking about DSCR loans. So, I can see that's going to be a big topic tonight. So, yeah, if you have any other questions outside of this chat, just shoot them in the chat. You on mute.
Okay, my bad. Sorry.
Yeah.
All right. So next. So what we want to talk about now is the difference between residential versus commercial loans. So I'm gonna just go through this really quickly. And if you guys have questions, stop me because we want to get to the content. Residential loans, essentially, if I'm right, and stop me if I'm wrong, Steph. Residential loans is for a property that is less than 5 units. So anywhere from 1 to 4 units. This is a single family house, a duplex, a triplex, or a quad, right? So these residential loans qualify for better interest rates and then lower down payments. Commercial loans are properties that are 5 or more units. So the second that is going to 5 units is a commercial product, which means that you're not going to get as good interest rates. You're also going to have to put a higher down payment down. And then also the way that they qualify you for the loan is different, right? So when we're talking about investment property loans, it can be residential or commercial. Our strategy that we're using is residential because we want you guys to do the lowest down payment if that's your goal, so that you don't feel like there's such a barrier in between it. So you can have an investment property that you use a residential loan on, mainly house hacking, and you can have an investment property that you use a commercial loan on. We're going to focus more on the residential loans for investment properties. So I put together just a little quick breakdown. This is all the things that my lender asked me to give them, but can you go through really quickly what it takes to qualify for a residential loan? And if there are any differences between qualifying for a loan for a single family, triplex, single family, duplex, triplex, or a quad?
Okay, so pretty much based off of this presentation right here, that's pretty much a lot of things that we ask for. In order for us to get somebody pre-approved, we typically requiring them to fill out an application and submit these main documents. You're gonna hear about these documents everywhere you go. They're gonna want you to submit your pay stubs. She said she has 60 days here, but 30 days will do as well, depending on how you get paid and the frequency. Bank statements, they will look at your bank statements. They will look at your tax returns. They will look at what you have saved up, and they will also need to pull a credit report to determine what your purchasing power is. It really doesn't matter whether it's a 1 or 4 unit. The process is the same, and you're going to have to submit these documents every time you're trying to qualify for a loan. Now, with that being said, one of the things that we also do, because I see recent, so all right, never mind. So with that being said, like I said, the same documents apply no matter whether it's a 1 or 4 unit property. It still falls under FHA. You can also use a conventional loan to purchase a 1 or 4 unit property and still be able to take advantage of that 3% down payment that you will have to put down. So it's all the same. You will have to. These are the most important documents that you're going to need in order to qualify, or in order for them to really give you an accurate picture of what you're able to afford.
Yeah, so when we say get your financial photos together, that means making sure you have access to these documents. Like, you may not have your credit report, but you have access to your bank statements. You're saving them to your computer so that whenever your lender asks for these documents, you can easily upload them. Sometimes they ask for your retirement statement if you have a 401k, because they may need to see that you have some additional cash reserves, your tax returns. What if I don't have a W-2 job? Then what are some things that I need for you in order to qualify? Because maybe I don't have pay stubs. I'm an independent contractor, so I don't have a job.
Okay, so if you don't have a W-2 job, typically for like independent contractors, individuals who own their own business, that's a whole different loan product for us, right? Because what we would have to do then is use your bank statements to qualify you, to use as your qualifying income pretty much. And what they will do is, depending on what lender you use, they'll take the last 12 months or the last 24 months and average all the funds that came through that bank account to kind of come up with a income number to use in order to qualify you.
Okay.
And of course, with that being said, I know it sucks that, because I'm an entrepreneur too. And when I go out and purchase a house, unfortunately, it's hard for me to take advantage of certain programs just because I don't have certain income documentation like W-2s or whatnot, right? So they would have to either use my bank statements or they'll have to use my tax returns. A lot of times what I've seen is that individuals who are self-employed, they have to use a bank statement program because they just can't qualify for a FHA loan or a conventional loan.
And then also, so if they're going to be using your tax returns or your bank statements, that means that on your tax return, you might have to declare your income. So I know a lot of people have these independent contracting jobs or side hustles, may or may not declare their income on their tax return. But if you're looking to purchase a property, you want to make sure you go back and declare that income. Even if you have to go back and refile, you want to make sure you declare the income so that you can qualify for something, right? It doesn't make it
Most definitely.
Yeah, you can't make $100,000 if you don't declare. They don't have anything that they can really use.
Because what people would do is they will make a lot of money, but then they'll also try to write off everything. And it kind of put their foot in their mouth, because now when you're trying to go obtain a loan, it's kind of hard because they're going to want to see what you made. They don't want to see your gross. They're going to want to see your net. And if you grossed $150,000 and you saying that you wrote off 120, then your company only made $30,000. And that's the figure they're going to use. And I said it's an average. So it might be less than that.
Mm-hmm. Awesome. All right. So we already have some questions coming in. Let me get to what are your loan programs that you offer. So, okay. So lenders have tons of different loans, right? The main ones that we hear about is FHA, VA. But from what I've heard, you guys have so many different loan products based upon your credit score, different loan products based on how much you want to put down a down payment. Different loan products for everything. Like if you want to put a property under your LLC versus your personal name, there's a different loan product. So is there any way you can go through with us, what are some of the loan products that you offer? That you offer?
All right, so let me put some clarity here. I don't work for a bank. I work for a brokerage. And for those who don't know, the difference between a bank and a brokerage is a bank would be like Wells Fargo, Bank of America, Chase, right? And these banks are only limited to the products that they can offer. And there's very limited product that traditional banks offer versus if you were to come to speak to somebody like me who's a mortgage broker, I deal with multiple lenders who do multiple things. So what will happen is, you can go to your traditional bank and they can deny you, but then you could come to me and I can approve you based off of your specific requirements or criteria that fits you, and I would just go shop that around to a lender that I know deals with profiles like this, right? So now that that's out the way, some of the programs we offer, we do FHA, we do FHA 203K. I just recently did a 203K loan for a client I had in Baltimore. We do VA, we do USDA, we do non-QM, which is mortgages or loans that you can't traditionally qualify. Like if you got denied for anything outside of FHA or conventional. We do DSCR loans. We have rehab loans. We have we got a multitude of products for each situation, and everybody's situation is different. So that all depends on that unique individual situation to where I'm a kind of push or try to figure out, okay, they might qualify for these type of products right here. Yeah, we don't offer NACA. Now,
Okay.
a lot of times NACA real estate agents deal with NACA. We don't necessarily offer NACA or even do business with NACA. But everything else, as far as loan products go, FHA, VA, USDA, conventional, the 203K rehab loan, down payment assistance. We got new construction loan. Yeah, we got everything.
Okay, we have a bunch of questions coming in. So really quickly, so you guys said you have all that stuff. You have the new construction loans. You have the new construction to perm loan as well.
Mm-hmm.
Taking a new construction, fixing it up, and then turning it into a permanent loan, essentially.
Yes.
And then he said that they have the 203K loan, which is if you want to do a rehab with an FHA loan. I'm sure you probably do the VA rehab loan as well, which is when you have a VA loan, but you want to do a rehab. And then they have a conventional loan that's called the home style, where they typically allow you to do a rehab as well. Mm-hmm. So because you're a broker, that means that you can go and find these loan products with a tons of lenders. Okay,
exactly.
So quickly,
it's not a.
Sorry, go ahead.
Go ahead. I'm sorry.
No, so yes, so that's perfect. So I'm about to go through these loan options really quickly, but slow me down. I'm thinking you guys know most of these things. So the FHA loan is 3.5% down payment. So whatever the purchase price of the home is, you're putting down 3.5% as your down payment. And because you're putting down less than 20% of the property, you have to pay private mortgage insurance, mortgage insurance premium, right? MIP, which is an additional payment in addition to your principal, interest, taxes, and insurance. All right. The VA loan, you have to be military or were in the military, and you don't have to put any down payment. Now, all these you still have to pay your closing costs, but with the VA loan, you don't have to do any mortgage insurance. USDA loan is Department of Agriculture, right? So it's 0% down, it's very similar to the VA loan, except for you don't have to be in the military. But to qualify for the USDA loan, you can only be in a rural area. And essentially, they have a map that tells you which houses qualify. So if you want to be in the city or the suburbs, you probably can't get the USDA loan, but you can only be in a rural area. Now, someone says, what about a USDA one-time closed construction loan? So can you do a USDA loan when you're building, I guess, on a rural piece of land? And or can you build on a rural piece of land and then refinance into a USDA loan? Where's the USDA map? I'll try to find it for you.
If you're already on the contract, change to another number for you.
So I know with the FHA loan, you can refinance into an FHA loan. So right now I have my property, it's a conventional. I bought it as a conventional, so I put 5% down. But if I wanted to do a rehab, I could actually call my lender and say, I want to refinance into an FHA 203K, and I want to use money to rehab this property that I'm already living in. So I know that's an option. But for the USDA loan, because a lot of people want to buy land, is there an option to buy the land and build on the property as well?
What interest rate?
Yes, that's for you.
I'm trying to see what question you're on right now.
Okay. And then so I'll go through the rest of them. So conventional loan is either 3% down or 5% down. You still have the monthly mortgage insurance, which is like the PMI, the private mortgage insurance, because you're putting less than 20% down. From what I heard with the FHA loan, you have to have that mortgage insurance forever unless you refinance. But from what I heard with the conventional loan, after you get to at least 20% equity, it can fall off. I don't know if that's still the case, but that was
it could fall off. But you're gonna have to contact your servicer to tell them, like, look, hey, take this off. I'm past that 20%, because they're not just gonna automatically take it off in all cases.
Yeah, and then sometimes what I had to do is I had to pay for another appraisal to prove that it had dropped, and or a broker appraiser, a broker opinion, right? A BPO, whereas basically they hired a realtor to come out. Well, I paid for it, but they hired a realtor to come out and give their opinion on the property value to see if they can drop off the PMI. So NACA, that's a whole different program completely. So most lenders don't offer that because that's a whole different program. The 203K loan, down payment assistance program. So if people want to use some sort of down payment assistance program, so Maryland, as you know, because you're here, has a ton of different down payment assistance programs. DC got like a good handful. But would you be able to find a lender that can work with some of those down payment assistance programs?
So I know with us, a lot of the times with these down payment assistance program, like the Maryland Mortgage Program, are specifically for like lenders, right? We don't deal with Maryland Mortgage Program, but a lot of other programs that we have, we work with other lenders who offer like down payment assistance, that 3.5 or that 3% that you need to put down on your home. We do work with Pathway to Purchase. That's the PG County program where they give you like $10,000. And I want to tell a lot of people about, when it comes to down payment assistance programs, right? They can help, but they also can hurt. And the reason why I say they can help and hurt is because, they'll give you the assistance or the cash you need to go towards your purchase. However, you still got to stay in a certain criteria. So what you would have been able to afford outside of that program, you might be now restricted because we have to follow their guidelines. So it kind of like goes through a double underwriting. We'll underwrite the loan and qualify you based off of their criteria, and they're going to underwrite the loan as well. Because I had an example would be a client of mine who originally got pre-approved for $350,000, and that's at the max. So with FHA, due to the DTI, that I can go all the way up to 57% on the back end. And DTI is debt to income ratio for the individuals who don't know. But with the Pathway to Purchase program, you have to stay restricted to 40%. You can't go past 40. So now you're talking about going from 350 to 280. So it can help, it can hurt. It all depends on what you're trying to accomplish. We also, like I said, I work with lenders who offer down payment assistance. I got the Max One program that offer that 3.5% down payment just for FHA loans. They don't do conventional. With DC, HPAP is also an option. Currently, HPAP has run out of funds until November. So whoever is trying to use HPAP right now, they won't get refunded until towards the end of the year. And then, that's a process as well. I want to stress that those individuals who want to use down payment assistance, I want you to understand it is a process. It's not like you just got the money and you could put it down and you can go on about your merry way. You have to go through a process, and we have to abide by the requirements that these down payment assistance programs have. And there's a few more out there. I actually have a link that I'm gonna share with you guys. You can actually go there, put your information in. Depending on what county in Maryland you decide that you want to purchase, it's going to pull all the down payment assistance that they offer in that particular area.
That's what I'm talking about. Love that. And then really quickly, we had a question about, does FHA have a HELOC option? And I think the answer is no, but I want to ask you, is there a HELOC FHA? I don't think so. So a HELOC is a second mortgage on the house, right? So you have your primary mortgage, which is your FHA, conventional, VA, whatever. And then you have additional equity in the house because of whatever reason. Maybe you renovated the house or the area increased or just the appreciation, inflation created appreciation. So you're trying to access just the equity in this house. So does FHA have a HELOC option? I've never heard of one. I don't think so.
I haven't done an FHA HELOC.
Yeah. I don't think so. I think a HELOC.
I don't think it does.
Yeah, I think a HELOC is because it's a second loan. It's a second loan against the property. I don't think that they have a HELOC. There are lots of banks that have HELOCs. A lot of banks will only offer you a HELOC if you have if it's your primary residence. So you will also have to talk to the lender to see like, hey, I have this investment property over here. I don't live there, but I have, $50,000 worth of equity. Will you give me a HELOC on this? And a lot of people will say no, but you might have one person that says yes. So keep Awesome. I was going to go through this scenario, but I think we have so many questions, so I want to kind of keep going through it. All right, so we talk about these renovation loans. These are just options for if you want to purchase a property and do a renovation. So the FHA 203K, you're putting down 3.5%, and this is going to be 3.5% of the total acquisition. So this is how much you're buying the home for and the cost of the renovation. So you're 3.5. So if you see the house is $300,000 and you think it's worth 500, you're gonna put 100,000 into it. Your 3.5% is of the 300,000 plus the $100,000 renovation. All right. You can use a FHA 203K loan on a property that has 1 unit, 2 units, 3 units, or 4 units. However, you must live in that property in order to use the FHA 203K loan. So don't commit fraud. You have to live in this property in order to do it for at least what? 1 year. So a year and a day, you can move out and do what you want to do, but to not commit fraud, you have to live there for at least a year and a year. The home style loan is like a conventional loan product. So typically it's 5% down, but sometimes if you have a second home, like you already have your primary home, you can put 10% down if it's a second home. Like say I want to get a beach house out in I think we have someone here who's invested on the Eastern Shore. If I want to get a beach house out near Ocean City or something, I can do a second home, and that's an option as well. Can you refinance with any lender, or do you have to use your existing lender? You can do any lender. So I can take my whole portfolio right now and go to Stefan and be like, hey, I want to refinance all my properties. Let me know what you have. Do you have any portfolio loans? Do you have commercial products?
Yes, we definitely have commercial products.
So I can say, do you have any portfolio loans? I want to refinance these I want to do this as an FHA because I haven't used it yet. I want to do a 203K. I want to do these as conventional. Yeah, I can do it to any lender. I can go to Bank of America. I can go to the lender I started off with, but yeah.
Yeah, I seen somebody ask if you're already under contract. Dang, what's the question?
Oh, sorry.
If you're
already under contract with one lender,
read that
you change to another lender before you close. Woo, child. Okay, as a realtor, I gotta speak out on it. Okay.
I got something to say after you finish saying what you're saying.
If you're under contract with one lender, can you change to another lender before you close? Typically, when we write an offer for you guys, we put in there the certain number of days you have to get approved for a loan, right? And for my clients, if it's a quick one, I'll say they've already been approved, or sometimes I'll give them 7 days or 5 days. But you have that time to not break your contract with the seller. If you're purchasing the property, you have to abide by that timeline. So you need to check your contract first. Second, you need to reach out to your lender to see if they can close in the amount of time that you need, because sometimes there are scenarios where for some reason, this lender can't get you through underwriting at the end and you have to move to another one, but will that lender be able to close you in the time that you need so that you don't default on the contract? So Steph, I don't know if you have anything to say about that, about switching.
Yeah, just for everybody in this chat, please try not to change lenders in mid transaction because all that's going to do is set you back, set the lender back, set your realtor back, and ultimately put your offer at risk.
Mhm.
You know, these sellers, they want to sell their property. That's like if you had a property, you want your money today or as soon as possible. You don't want to keep waiting for all these setbacks or hiccups that's going to happen. You know, I actually had a client who got it pre-approved through me. I sent her the processing. We start underwriting the loan. Then she wanted to go to her bank. Her bank ultimately denied her, so she had to come right back around, back to us. We had to do the process over again. We had to pre-approve her. We had to send her back through processing, and it just took delays. And I'm talking about this particular deal started in January with her. 3 months later, she comes back to us, and we have to start the process over. And we didn't ultimately end up closing on that loan until 90 days.
Hmm.
I want you to understand something. When you're applying for financing or trying to apply for a loan, you want to make sure you got everything, all your ducks in a row, because you know what these people is going to ask me. They're going to ask me for income documentation. They're going to ask me to verify this. They're going to ask me to verify that. So if you know exactly what you need, and that's what we're here for, to kind of give you guys what exactly you need so you can be prepared, because how you start in the beginning is how you're going to end. You delaying stuff, you taking your time getting the documentation needed in order for the underwriters to come up with an ultimate decision, that's going to cause delays. So my advice would be to make sure you have everything together at the forefront so it could be a smoother process. And the only reason that that loan took so long is because it's a 203K loan. It's not a regular FHA loan. It's a rehab loan.
Okay, because I was gonna say what the seller could do is maybe they're getting backup offers and you don't know about it. So they could say like, oh, you weren't able to close, you're switching loans. Like, oh, okay, well, guess what? We want to take your earnest money deposit, however much you put 3,000 down. We want to take that and we're going to cancel this because you didn't keep up with what you were supposed to do. Because there is something in the contract that says that one of the ways you default as a buyer on the loan is by switching from a lender that already had you approved to someone who didn't, or just switching lenders can cause you to default. So if you had one lender and you got your pre-approval through them, and then you switch to a different lender and that different lender can't close you, there is a clause in the loan in your offer, in that Maryland or DC real estate contract that says that could cause you to be at default. So typically, if you do see people switching, it's because their first lender couldn't get them through, right? If my first lender can't get me approved, then I legally can get out of this contract. Now I could try to save the contract by going to a different lender, but theoretically, I'm going to try to go with the one that I'm already using. You guys are talking too fast. I can't keep up. I'm sorry. I'm going to slow it down. I promise. I lie. I'm going to try. Okay, so we do have people who want to hear about commercial products. I think we get into that in a little bit. Home style, I don't know the answer to this. So with the home style loan, so kind of like that 203K loan, but the conventional home style, for 3 to 4 units, do you have to put down at least 20%? I feel like I've heard that. I need to check with my broker, because the home style is a conventional loan. If you're going to live in one unit, but it still has 4 units. That's a good question. I'm not sure if you know the answers to that.
So what I've seen with home style, you couldn't use 3%.
Okay.
They do have 3% products for home style.
Okay, for 3 and 4 units, for like that, those multi-units, I think that's the main.
Well, it's still not over 4. So they got the traditional, the 1 through 4. So it's still not over 4. So I don't see why you wouldn't be able to take advantage of the 97% and still be able to get from 1 to 4 units.
Yeah. Okay. Yep. That's what I was thinking as well. If it's your primary residence, then you should still
It definitely,
3 to 5%.
That's another thing. It has to be a primary residence as well.
Because I thought the non-primary residence was automatically 20%, 20 to 25%.
And you know what's crazy, Tiana?
Yeah.
I've gotten that a lot from agents who
Really?
think that they think that you can't use 3% regular conventional loan. They typically want you to put 20% down, which is just not true. I guess it all depends on who you're talking to and what lenders you go to. Like I said, lenders offer certain things. Brokers have access to multiple things. So you definitely can use it. And you can use the 3% down on the condo if That's what you
Exactly.
mean.
So for people who want to do FHA, because you're just like, FHA is typically if you have a lower credit score, whereas conventional requires you to have a higher credit score. So I think conventional, they start at 620, and FHA, they start at 580. So the pro of going FHA is if you have a lower credit score, you can still get in the game. But if an FHA is 3.5% and you already have good credit and your lender can give you a conventional loan for only 3% down, hey, you're saving some money there. So those are just things to consider as well. My lender only gave me 5%, so I thought 5% was the lowest. So I had to call her and be like, I done bought 8 houses with you. Why? I never got 3%. What happened? I was mad. So my credit must not be right. Can you still use the FHA if you have a high credit score? You sure can. You can use the FHA. The thing with the FHA is that it's a one-time you can only use it one time, but there are caveats to it, right? So, and I'm gonna just, well, I'll actually, yeah. So one time, unless you move X amount of miles, how much is it? Like, I think
It can't be in the same zip code, and it got to be over 3
I think
years.
it's like, is it 100 miles? I feel like one of y'all, G might know how many miles away you can move when using the FHA loan. Like if you need to move states or something, or what you were saying earlier when Chandria was talking is that if your person, if like one partner in a marriage has a loan under an FHA loan under their name, if their partner is not on that loan, then their partner can go and use the FHA loan, right? So it's different ways to get around it, but I would still say like typically it's like a one-time loan, and you can refinance into an FHA loan, or you can refinance into a FHA 203k. So, but it's a one-time loan. Conventional, you can use it over and over again. But FHA, they're strict.
And the thing with, go ahead.
No, I was just gonna read. FHA guidelines require that your new home be at least 100 miles away from your current home. So that's the FHA 100-mile rule. Thank you, G. That's our other market lead, you guys.
So I just want to say this last part about FHA versus conventional as it pertains to the interest rates. A lot of times FHA rates, most of the times FHA rates is lower than conventional rates. So it all depends on, like, a person might say, I don't want to pay more than XYZ a month. Okay, you might qualify for both products. We're going to offer you to make a decision based off of what you want, whether it be a low down payment or no mortgage insurance. So the difference between those two is, if you want to lower interest rates, then typically you might want to use an FHA loan if you never use one versus a conventional, because they're going to be typically higher.
Yep. All right, perfectly said. I'm just going through these. So G put in there's 4 exceptions to the FHA 100-mile rule. Number 1 is relocation. If you're increasing your family size, so maybe I bought a condo with the FHA and now I done got married, I got kids, and I want to use another FHA to buy a bigger house. They may make an exception for me. Vacating a joint owned property. So if I'm leaving my partner, whoever, and we were on a loan together and I want to go buy my own house, you can do it. Or non-occupying co-borrower. Non-occupying co-borrower. I gotta look that one up. I haven't heard that one before.
What is that?
If you're a non-occupying co-borrower, that could be an exception to the FHA loan. So maybe you're on the FHA loan, like, right? So my mom put me on her loan when she bought it, but I don't live there and I want to go buy my other house. That's how I'm thinking about it. I want to go buy a house of my own. I don't live there. I could possibly use an FHA loan.
But she wants to still be on the application to help you out in some way.
Or so maybe I don't see her,
So like a non-co-borrower will be somebody who doesn't necessarily live in the subject property, but is actually still on the application. They can even own their own home. It will be like the scenario you just gave, a mother and a son finally moving out, and the mother wants to help the son, and she adds onto the application for income purposes, but she still owns her own home.
Got it. Okay, I like that. Okay, awesome. All right. Okay, and then someone asked, can you use the FHA loan to house hack and get a 4-unit, 3-unit, 2-unit, or 1-unit? Yes, we the multi-family movement. You can use the FHA loan to house hack. You can use a conventional loan to house hack. as long as you're going to live in the property, these are loan products that you can use, right? We haven't even gotten into commercial properties that you're not going to live in. So as long as you're going to live in at least one of the units or in at least one bedroom for at least 1 year, you can use this FHA loan, and you can also use a conventional loan. All right. Okay, so let me just go to, okay, so down payment assistance program. Someone asked me to drop these links in the chat. And so these are just, so Steph has a better link that will basically allow you to put in your address and see all the programs, no matter where you are. I'm a realtor licensed in Maryland and DC. So these are the ones that I've came across. In Maryland, they have a ton. M&P Maryland Mortgage Program, anywhere from 3% down payment help to 5% to 6%. So many different options. Baltimore City has a ton of programs. Montgomery County has one. I gotta tell one of the guys about this. Greenbelt has one. PG County has a pathway to purchase. So all of these are programs. Now, each one of them operates a little bit differently. They have like the Smart Buy program, which they will pay off, I think it's up to $30,000 of your student loans. So each one operates a little bit differently. Some of them you have to take a workshop before you even start looking at homes. Some of them you can be under contract and take a workshop then. Sometimes the workshop is 8 hours, sometimes it's 2 hours. So everyone's going to be a little bit different, okay? So keep that in mind, that when you go through here, I try to summarize it, but you really need to figure out what exactly you want to use. And this is why it can become a little bit stressful using these programs. And sometimes lenders offer similar programs, right? So lender may offer an option that will pay your down payment. It's not one of these programs. It's just a loan product that they have. Like, hey, we'll cover your down payment as a second loan or as a grant.
Exactly.
And then DC
I was trying to share the link.
Okay. Yeah. If not, you
share the link to the down payment.
And then if not, then you can send it to me and I'll share it as well.
Okay.
So also send the presentation. Yeah. So as long as you guys have your email in the chat, I'll send this presentation out. And then we're also recording as well. So we'll send that out as well. Just remind me to not to not close out before I get all y'all emails. So I'm going to ask again at the end for the emails, because I'm gonna have to go to the chat, so I don't want to miss anyone. So private money, I'm gonna just go through these really quickly because I know we had a question about commercial products. So private money, so a lot of times we talk about using private money in order to purchase real estate. That can be from anyone. That can be from your auntie who has equity in their house. You got all these boomers who are sitting on all this equity in their property. Like, you may be able to ask one of them to take out their home equity line of credit, right? You don't have the money, but you have the know-how in order to go and get the property. So you may ask them to take out a HELOC and then lend it to you so that you can do it. So that's private money, right? You create your own terms. You kind of create your own contract with that person, whether it's verbal or non-verbal, you create it. Or some people just have savings, they just ball in. Some people take out lines of credit against their business. So there's so many ways to get private money. Hard money is something that I think there's someone else on here, if Laura's still on here. I've used hard money before as well. Hard money is basically a form of private money, right? Because it's not a traditional lender. Basically what you do, I didn't know my slides were messed up like this. I'm gonna fix these slides before I send them out, y'all, so y'all can see it. Basically with hard money is you're going to a company and or person, they're going to lend you money based upon your experience with real estate investing. They tend to only lend to an LLC, and they're going to lend to you at a higher interest rate. In addition to this higher interest rate, is going to be a shorter term. So with your traditional loan, you can get a 15-year loan or a 30-year loan for the most part. With hard money, they say you got 1 year. 1 year, we'll give you this money, and in this 1 year, you need to do whatever you need to do. Whether you're going to fix up the property, you're going to just buy the property and then call like Steph in order to refinance it, or you're going to fix up the property and sell it, or you're going to fix the property up, rent it, and then call a lender. You got to figure out what you're going to do, but you only get 1 year in order to do it. Sometimes they'll extend it, but that's the hard money option. So a lot of times people use hard money because they're going to write cash offers. So we're in the Baltimore area, right? In Baltimore, two of my Baltimore properties, prime example, one was $60,000, one was $70,000, right? Instead of me going down, at that time they were both worth around 120. So instead of me going to use my cash, so I used my HELOC, but what I could have did is went to a hard money lender and said, hey, I need $60,000 to buy this property. Matter of fact, I need $80,000 because I want to buy this property for 60 and then use $20,000 to renovate it. And I'll pay you back this $80,000 in 1 year, or I'll pay you back monthly towards it, but pay you it all in full in 1 year, because after that 1 year, I'm going to go to my lender and I know this property is worth $120,000. So I'm going to put a regular loan on this property. And as a result, I can pay my hard money back and then use any additional money to go towards a house or keep it, right? Or I'll take the same property and I'm going to sell it. All right, so that is the strategy of using hard money. It's just a shorter term and way higher interest rate. Now, when you actually work with lenders, this is kind of like an off the market strategy. Lenders are going to give you more traditional strategies. So they may have something that's very similar to hard money, but what they may call it is something different. So they may call it like, hey, like for instance, with hard money, I don't have to have a certain credit score to qualify, or I don't have to show them my bank statements or have a certain job to qualify. Your lender may have something similar, but they call it a DSCR loan, debt service coverage ratio, right? So that loan may be similar to how hard money operates, but it's a little bit more regulated. So I might want to go that way because it looks, it's more comfortable. So with that being said, can you talk about if you have what is a DSCR loan? What do you need to qualify for it? And also if you have any other type of loan products that are like not as conventional as the FHA or conventional loan.
So a lot of times when it comes to these commercial loans, it's based off a scenario, right? Because I have a lot of lending partners who I would have to submit a scenario to for them to either come back with me, for them to come back to me with a plan. So outside of that, if you have a commercial scenario, whether that be you trying to finance a 20 unit to 50 unit apartment complex, it really doesn't matter, because all of it is going to fluctuate depending on what the scenario looks like. A product that people typically use is a DSCR loan, like she says, debt service coverage ratio loan, and they pretty much base that off the actual investment, the actual property. So they're going to look at, okay, I have this 5-unit apartment complex right here, and it's going to cost me $2,000 a month, but it's going to generate me $2,500 a month. So, and it's a lot of different criteria depending on who is offering the DSCR loan. To go in specifics about that, we will be here until tomorrow, and a lot of questions that you all may have pertaining to that, I wouldn't be able to give you right now. But the main thing is that DSCR loan that you use for rental, you can do we have fix and flip loans. We have rehab loans on the commercial side, of course. We have transactional funding, which is for those who are interested in like wholesaling or anything like that. Transactional funding would be just funds to get to the next transaction. We also have fixed to rent. Oh, screw my screen. Yeah, we also have fixed to rent. So all these products we have access to through our partners. And like I said, it's based on each scenario. So once I know what the scenario look like, then you'll have a better understanding as to exactly what it is you would need to be bringing to the table, whether that be, okay, I got to pay interest only payments for the first year, or I got to put down 20% because I'm a new investor, so it all depends. It's not a specific thing outside of like a DSCR loan that I can say that, okay, this is a product, because we have partners who offer funding for projects. So it's not necessarily, oh, this is the name of the product, but they just offer funding for products, and this is what they do.
Yeah.
They fund these type of loans, whether that be, a fix and flip or fix and hold or whatever it may be. So when it comes to commercial real estate, it's a little bit different than, residential, and it all based off of the individual and the individual deal.
Yeah. So just to summarize, if I'm buying a residential property, meaning 1, 2, 3, or 4 units, the bank is primarily looking at my qualifications as the owner occupant. They're looking at me as the owner of the property, how much I make, and if I can afford these payments, right? If it's a 3 or 4 unit, then they may consider some of the rental income, but they're also mainly looking at how much do I have saved, how much do I make? If I'm doing a commercial property or a commercial loan product where like DSCR, debt service coverage ratio, the bank is not necessarily looking at me and my personal credentials, they're looking at the deal. So is this a deal that's going to make money? Is this a property that is going to be worth X amount in the end? Is this a property that they're going to rent out for this? So I have to basically know my numbers well enough so that I can get this property or this deal approved by this commercial lender so that they would want to lend to me. All right. Okay, so how do we, we don't, you know what, y'all are asking so many questions. So really quickly, before we go into questions and answer, one of the things that we forget to do all the time is take our picture. So I want everyone to come on screen. We're going to take our group photo real quick, and then we're going to go into question and answer. And then also, you guys can't leave because you have to resend your email so that I can send y'all this presentation. All right. So let me get everyone. If you feel so comfortable, take off your look at the beautiful faces. This is my favorite. I get to see who I was talking to this whole time. Look at this. Hey y'all. How you doing? What's going on?
Emails.
I'm walking.
These questions is coming in.
Yeah. G said we need to do a file. We can do that as well. All right. Oh, I've seen some face I haven't seen in a while. Okay, so we have a lot of people on here. So I'm gonna have to take 2 pictures because I have 2 screens. So everybody say cheese. Oh wait, I'll do a screen clip. I'm gonna do 2. So hold on 1 second. Don't say cheese yet because I don't want you to waste your smile. All right, screen clipping, snipping tool. All right, everybody say cheese and hold it. All right, that's the first one. Hold on 1 second. Let me make sure that's saved. This is part 1. Save a snap. This is going to be. All right, this is our DC group. So DC part 1. And then I'm going to go to page number 2. So you guys, everybody, hold on 1 second. Let me just do the screen clipping again. All right. So once again, everybody say cheese. Y'all are so beautiful. Oh my gosh. Okay. All right. Okay, so now we're going to go to the question and answer section because you guys had a lot of questions coming in. I can pull up the presentation at any time so that we can continue to talk about it, or if there's some page that you want to go through, but there's just a lot of questions that came through. So I want to make sure that we get to the questions. So I'm going to just start from the top. Can you send written HELOC instructions to the group? I can find an article that goes through the reasons why you would use a HELOC. I feel like I actually wrote a blog about this, why you would use a HELOC versus a cash out refinance. And then also, yeah, I can send out resources relating to HELOCs. Or Steph can too. If you have.
Tiana, do you have everybody's email or those who are interested in that information?
Yeah, so some people, I have their email, they got access to this through the email, but other people were probably in one of the group chats, so they would need to drop the email. So that's another thing we need to go through is make sure we have everyone's email. And actually, I'm gonna put in our 2 emails. If y'all think like she might miss me, I'm about to put in my email right now. And then Steph, can you put in your email as well? If y'all like, wait, she might miss my email and I want her to make sure, you can email us directly so that we don't forget about you. I don't want, it's not going to happen, but I'm speaking that it's not going to happen, but yeah. Okay, so what's the market like in the DMV? I'm a wholesaler. I don't know much about the market in the DMV. Like what are single multifamily homes going for? What zip codes are hot? Definitely. What you can do is email me. I can send you the automated listings for the different areas so that you can see them as they come on the market, right? So DMV is big, right? We got DC. So DC, you can find a 4-unit for $800,000 or $5 million. You got Maryland.
That's terrible.
That's terrible. For a 2-unit in DC, you're looking at maybe $350,000, $400,000 to like 800 to, I've seen $1 million for like a duplex. And then in Maryland is even bigger because you have submarkets in Maryland. So I invest in PG County. So I always tell people I can buy a $50,000 single family home in Baltimore. I can buy a $300,000 single family home in PG County, or I can buy a $500,000 single family house in DC. So really PG is kind of somewhere in between that. There's just not a lot of multifamilies on the market in PG. Like I normally do analysis at the beginning of each of this meeting just so y'all can know. And actually I can pull that information up, but I don't want to take up people's time. But yeah, I normally just go through and see like how many multifamilies do we have. And literally PG always has the least amount. DC has a good amount, but they're expensive. And then Baltimore has the most. The Baltimore properties, they say like what zip codes are hot. Oh, that's a whole question. Okay. In Baltimore,
You got Brooklyn.
listen. Okay, all the 2-1. So 21220, 21220, 21219. I bought a property in 21218. I have property in 21229. So there's just so many different properties. I think there's an article that goes through some of the neighborhoods. If you're really not from this area, you want to be an out-of-state investor, Baltimore is block by block. So even though you find a beautiful house on this one block that's amazing, and you say, wow, I found this house, it's $300,000. The next block over, there's a property for $50,000. It's the same layout. Let me get this one. No, it doesn't work like that, because that next property could be all abandoned buildings except for that one property, or it could be crackhead central. It can be like it could be an active drug block. So Baltimore is truly block by block. You have to drive the neighborhoods in order to see, because you will get caught up if you don't do that. Akil said, does your company offer DSCR loans? I think he said yes, because he's a broker. So he basically shops your profile to different lenders in order to find the products that can work for you. Slow down. Okay, I got it. All right. All right. A lot of people want information about HELOC. Yes, you'll get a copy of this presentation as long as your email is in here, or you can email me proactively. Do I have to pay PMI for commercial property? Or do you have to put down 20%, and would that automatically knock out PMI on a commercial loan? iPhone, you are correct. Once you put down 20%, you don't pay PMI. So you're only paying PMI or MIP, which is mortgage insurance, whenever you're putting down less than 20%. Now some banks won't even, like my lender, she was just like, oh, you don't have to pay PMI. And I was like, oh, great. But I didn't know I had a slightly higher interest rate. So I'm paying it. It just don't look the same. So once you put down at least 20%, you don't have to pay mortgage insurance. Mortgage insurance is basically, oh, this person's buying a house, but they're not putting down a big enough stake. So we need some sort of insurance, some sort of protection for us lenders, just in case they default on the loan. So we pay our home insurance. The lender wants you to pay mortgage insurance just in case you default on the loan. That's what PMI is. Can I use contract value? I'm not sure what context this was in. So babe, you can clarify what you mean by that. That makes sense. Yep. 2 ways to verify an entity's income is through bank statements. So you can do the bank statement loan, or through your last 2 years of tax returns. So file your taxes. We talked about the debt coverage loans, which basically says like they want to look at the actual property, the deal. If the deal is going to make money either through rental income or through like when you're selling it, they're looking at that in order to qualify the loan. Oh, this is a good question for you, lender Stefan. What's the ideal loan package / layering that gets people the best savings on real estate transactions for multifamily properties or multi-use property?
Hold on, because that was a thick question right there.
So we want to buy multifamily or a mixed use property, right? Multifamily, multiple residential units, 2, 3, or 4, or mixed use, maybe commercial unit at the bottom and an apartment upstairs, something like that. How should we look at this in terms of strategy when we're going about it? What loans should we use? Are there different loans that we can layer with each other so that we can get the best savings? We're trying to save the most money but still get this property.
So the way you're going to save is always going to be through FHA or 3% conventional. it's hard for you to package those because you can't be in two places at one time, right? So you would have to start off with one of those products to kind of push you into the next one. So in order to package something, it would look like this. Okay, I want to buy a 4-unit apartment building. I'm gonna live in 1 unit and rent the next 3 out. I'm gonna stay in for a year. Then I'm gonna go find another primary residence, right? I'm gonna go find another primary residence because I just refinanced this 4 unit that I was just staying in. Use that money for the down payment to purchase my new primary residence. Now you may not qualify. Now you depending on what your income is. Some loan products that conventional, some loan products that conventional offer you still can be able to put 3% down, but it's gonna be based off your income, not necessarily whether you're a first time home buyer or not. So it's so many different strategies that you can use. I don't think we're gonna be able to get to all the strategies tonight, but I'm willing to definitely sit down and talk about some different strategies that you can use or implement to go about your investing career.
Yeah. And that's a good point, is that at the end of the day, like each person's scenario is going to differ a little bit. So you might want to just talk to your lender, figure out what you can qualify for, right? Because we can tell you like, oh yeah, you got to do X, Y, and Z. But if you don't qualify for that, then maybe it's not an option for you. Doesn't mean it's not a good option, but maybe that's not an option that you can use. Or maybe you still want to buy an LLC. People are like, oh, I really want to buy an LLC. I'm going to get an FHA loan and I'm going to transfer my property to my LLC immediately. No, need to wait a year.
That's not happening.
Don't do that, you guys. So yeah, so definitely, I feel like get pre-approval. That's the main thing. Before I even work with a client, you need to get pre-approved because we need to know what we're working with, what you qualify for, and like your lender, or in this case, broker, can tell you that all the different loan programs that they have. Really, they can just see for a person that has a 680 credit score and makes $70,000 a year. This is all the things I can offer you. And then I say,
also,
sorry, go ahead.
Now, I just don't want you guys to get caught up in trying to take advantage of the least amount of money that's coming out your pocket. I want you to understand that, using these products that they have that only allow you to put 3.53% down is just a stepping stone. Once you get that first house and once you get in the door, you taking off from there. You don't necessarily need to keep using them, because now you're going to have the asset or you're going to have the capital in order to invest in your next deal, whether that mean you got to put 10% down, whether that means you got to put 20%, whether that means you got to refinance over here and put this money over there. Just see it as a stepping stone and not, oh, I'm gonna get all my investment in properties at 3%, because that's not logical. It doesn't work like that.
Yep. Yeah. So what I do is, because I'm in DC, I use my low down payment loans. Like I haven't used FHA, but mine's like 5% down conventional. I use that for DC because DC is so daggone expensive. So that'd be like $40,000 right there. But that same $40,000 in Baltimore is 20% down on the property. So because I'm not living in the properties, when I'm buying a property in Baltimore, I'll put down the 20% and I'll save my primary residence loan options for the low down payment loans in DC, because DC is the most expensive. So I don't want to put down 20% of a $600,000 property in DC. That's like $120 something thousand. I'm not trying to do it. Okay. Do children of veterans qualify for the VA loan? That's a good question. I have no idea. I never heard that before.
I've never had the experience to see a children of a veteran qualify, because even the wife of a veteran doesn't qualify if she wasn't the one in the military.
Okay.
So I'm gonna say that no, children do not qualify if the parents are veterans, because I know some benefits go to the wife and kids, but I just don't know if it goes that far, and I've never have seen it.
Yeah, I haven't seen that happen either. Yeah. NACA.
I want to ask a question. Excuse me, sorry to cut in. Based on what you were talking about VA loan, can you use VA loan for investment?
Same thing applies when you.
Sorry,
same thing applies with an FHA on. It has to be owner occupied. So if you look at the investment as though you putting 0% down, then in your head, it's like, yeah, I'm using it as investment because I'm only paying for closing costs. But at the end of the day, it still has to be is an owner occupied. You
Okay,
have to stay in the property for that period of time, that year.
Right.
So owner occupied investment is probably when you're house hacking. So you're living in it and renting out a portion of it, whether it's living in one unit and renting out the other units, or living in one bedroom, renting out your basement, you're house hacking. That's our real estate investor strategy for using these traditional loans. Because most people don't think about it like that. They just go out, buy the house. We're trying to figure out how do we use these same loans and become real estate investors. So the NACA program, I think I did a video on that before, but NACA program, most lenders don't use it. NACA is a self-sufficient program, so they have their own lenders, their own program. It's a long process, but for some people it's worth it. The thing with NACA is that you have to live in the house for the life of the loan. So if you want to get a property and move out after 1 year, you can't do that with NACA, or not that you can't do it, but you have to pay them back up to a certain amount. So keep that in mind with NACA. USDA one-time construction loan close. I'm gonna look that up. So basically you're saying a USDA construction loan. If you're under contract, we talked about changing lenders and the cons of doing that, how you could lose the deal, you could put your offer, you could put your contract in jeopardy. So it's not suggested, but if you need to do it to save a deal, then go ahead and do it. Also, like that first couple of days, like 2 or 3 days after you're under contract, you may be able to change lenders, but just make sure that next lender that you're using can get you qualified. They can get you to closing. What is the interest rate range on home style loans? Oh, can you talk really quickly about the difference between interest rates for a regular FHA versus a 203K, or a regular conventional loan versus a conventional home style rehab loan?
So look at it this way: with a regular FHA, interest rates are typically low. Those are some of the best rates across the products that you can use to house hack or to even just live in a property. When you're talking about doing more things like renovation loans and things of that nature, then the lender will look at it as more risky, and therefore the interest rates are going to be slightly higher than just a regular FHA loan. And like I said before, conventional rates are always almost higher than FHA rates. And especially when you're talking about like home style loans and you're talking about doing renovations, and it's more pieces that's moving around. So they have to kind of protect themselves and kind of charge you more on the long run in the form of the interest that they're going to charge, if that makes any sense.
So whenever you're adding a renovation component to it, your interest rate is going to be slightly higher because it's more risk. Faye, I was just about to read your question, but you have your hand raised. So go ahead, Faye.
Oh, thank you very much, Tiana. Can you hear me okay?
Yes, we can hear you.
Okay, great. Yeah. So the first thing I wanted to clarify is that when you asked about contract value, is the fact that if you are a business owner and you do GovCon, sometimes you get contracts that pay you quarterly based on the quarter. And I was just wondering, could you use that as a qualifier for financing? The reason why I raised my hand is because in the Baltimore market and also the DC market, you do see a lot of properties for sale. And what I just wanted to comment on, because you mentioned this thing about Baltimore being block by block, but I just want the people who are considering those markets to be cognizant of the crime rates. Because even though, oh, wow, I got a property in the DMV or Baltimore is up and coming or whatever, guess what? And I say this when I'm talking in Julian's class too, Black on Black crime is real. I've been a victim twice. I'm a survivor. So I didn't go through my counseling. Everybody else around me did, but I saw how devastated my family was. I knew I had to get myself together. But I don't want to be like a victim on this. I just want people to know, if you're doing that house hacking thing, that's something that you absolutely need to take into consideration.
Yeah.
And this is because in Baltimore, Tiana,
yeah,
I mean, everybody's selling.
Yeah.
Because they want to get out of that market because of the crime rate.
So that's also really important.
Tons of houses for sale.
Yeah.
Tons.
So my out of state, because I do have some buyers who are putting down the 20-25% and they don't plan on living in the property. they are looking at different properties and they can cash on different properties than my owner occupied buyers. And I go through this with my owner occupied buyers. They're just like, oh, this one's cheap, this one's that. And we always come down to is like, do you want to live in this neighborhood? So if you're owner occupied, I could send the same property to a person who will not be living in a property and a person who will, and it could be a great deal for the person who won't be living in a property. They're just going to hire a property manager who already knows the neighborhood, knows the demographics, and it could be a horrible purchase for the person who wants to move in with their family. So you really have to understand that if you're out of state, like, yes, you can possibly take more risks if you're not going to live there, but you also need to hire on-site property, not on-site, but on the grounds property management company who knows the areas, knows how to collect rent, knows how to go about the eviction process. If you're planning to live there, you need to drive the neighborhoods, period. You have to drive the neighborhoods to see if that's a place you want to live. And what ends up happening is, what I've seen happen is that the properties that in areas that you want to live in are going to cost a little bit more, which means they're going to cash flow a little bit less than those properties that are great cash or cash return, but it's not an area you want to live.
Right. And because in DC, you might think you're getting a really good deal, but at the end of the day, those people know who's moving in the neighborhood and they're predators. They're predators. And if you look like you don't belong, you don't belong. And they know that. So, you know, you could be setting yourself up. I'm just keeping it 100 because I care. And I've been there. And it's not pleasant to be mugged at a knife point or gunpoint, and it happens.
Yeah. But thank you so much for sharing. I do want to go back to your original, Steph. If someone's using a contract and maybe they get paid quarterly, maybe they're they don't have the W-2, their government contractor. How does that work? Are we still looking at their W-2s or like bank statements? How will that work?
I mean, we definitely gonna have to look at their tax return because at that point they're an independent contractor. You know, and that income has to be reported on their tax return. It all depends on how long their contract is as well.
Yeah. Yeah.
You get what I'm saying? How consistent in that particular line of work that they are to determine, okay, is this income going to be consistent or is it just for this time being? You know, so it all depends on the contract itself, because I have had a client who do contract work, maybe not for the government, but they're an independent contractor. So they contracts last for about 2 years, you know, with a chance to renew after those 2 years. So it all depends on what the contract is, how long the contract is. And, you know, that's pretty much it when it comes to that, using that as an income.
Yeah, Tiana, thank you very much for going back to that issue. And I'm really glad that Stefan brought that up, because that's why I brought it up. Yeah. Contract value, and that's the way the government does basis. 12 months, 6 months, or whatever, contract value. And is the best scenario to do a debt coverage loan? What is the best scenario for that? Or are you just stuck because you don't do a W-2? So I'm glad. Thank you, Tiana, for going back to that. Go ahead.
No, I was saying that all depends on what you're trying to do and what your strategy is. Like,
well, I'm on a journey like everybody else, you know.
But I mean, we could set up another call and try to figure out what it is you're trying to do. And if that's the way you want to go about trying to purchase something, then, you know, we could talk and try to figure something out.
No worries. Thank you, Tiana, for that.
You're welcome. So we talked about the reasons why you would use the FHA loan, which is the lower down payment, and also you have a lower credit score. You can use the FHA loan, and then they have some really good interest rates. First time home buyer, there's tons of different programs, but you can use the FHA whether you're a first time home buyer or not a first time home buyer. We put the USDA map in the chat, and I'm going to copy and paste that so that you can see how to qualify for a USDA loan when I send out this email. No, there's not a HELOC option for FHA. HELOC is a second loan on the property. So essentially, you're only taking out a loan to access your equity. And let me just clarify, if you have a property that's worth $100,000 and you only have a loan for $80,000, they're not going to give you the $20,000 difference as a HELOC. The HELOC is also going to look at the loan to value. So they're only going to give you 75% to 80% of the value of the home, because they still need you to have equity in it. So you would need to make sure that your equity is above and beyond what that is. So take the value of a home, multiply it by either 80% or 75%. And then now that new value, subtract your current how much you currently owe on your house, that's how much you qualify for your HELOC. I also like the HELOC because they didn't make me pay closing costs again. So I like that option in comparison to the cash out refi. Will you guys get a copy of the presentation? Yes, I'm going through right now. And as I'm looking at your questions, I'm also making copies of the emails. More emails. Can you refinance if you have a lender? Can you refinance with any lender, or do you have to use your existing lender? So we talked about that. You can refinance with any lender. So like, for instance, my lender, once I got to 5 properties, her bank would not allow me to buy any more properties with her. She really said it was only supposed to be 4. So I had to go to a different person, but also I want to continue to use her. I liked her. No offense, Steph. I'm gonna use you too. Just like, but what I did, it's Caliber.
Oh, it's okay.
Yeah.
You can't use her no more.
Okay, all right, never mind. So now, but what I did is I refinanced a couple of my loans out of her to someone else so that I can continue to close, because I know she's not clocking me. I'm not saying she's just gonna approve me, but because you had to get pre-approved for a loan. Let me be quiet. Can you refinance? Okay, let's hear about the commercial products. Okay, so commercial products, from what I gathered, is based on the deal. It's basically, commercial is anything that's 5 or more. It's also a lot of the different types of products. So for instance, if I want to take my portfolio, I have 9 houses, but say I want to take 4 of them and I want to put them all under one loan, like a jumbo loan or portfolio loan, I would have to go to a commercial lender to do that and say, hey, I want to take each of these houses and I want them all to be under one loan. So I'm paying one monthly thing versus 4 different loans. I need to go to a commercial lender to do that. And the commercial lender is going to look at, am I going to make money on this property? Is my cash flow right? What's my cash on cash return? They're going to look at your cap rate. They're going to look at how much can you sell the property for. So those are commercial products. You can use the FHA 203K or the home style conventional loan. Those are both rehab loans, so purchase and rehab the property for 1, 2, 3, and 4 units. For the most part, from what our understanding is, you still only have to put the lower down payment down, which is either 3.5 or 5%, as long as you're living in the property. The presentation talked about DPA, which is down payment assistance program. So I'm going to send out the link to that. DPA, I'm going to send out DPA Maryland and DPA DC. Okay, what's the percentage of time you have to live in a house under FHA in order to not commit fraud?
Yeah.
Funny. Okay.
Can I give voice to that real quick?
Yes, please do.
So I'm under contract. I'm supposed to close September the 8th. I work in DC, but I'm buying in Baltimore, and I also live like right outside of DC. So my commute time is about to quadruple from 15 minutes to 90 minutes. And so I'm trying to figure out like what's my best strategy to be able to keep my apartment, but also to be able to, because I'm going to rent rooms out in the house, but I'm also going to leave an area for me. But I'm just trying to figure out the best strategy so I'm not being fraudulent.
So how did you purchase the apartments?
The apartment I'm in, I'm just renting. It's close to my job and it's in a good area. So
you're just renting.
Yeah, I'm just renting this apartment. So I just want to make sure that it's, I don't, you know what I mean? Like if I go to refinance in a year, they're like, why do you still have that apartment?
Got you. So do they allow subleasing at that apartment?
Somewhat. So I thought about the idea of kind of doing that too. So.
I mean, because at the end of the day, in order for you to close on that loan, that has to be your primary residence if you don't want to commit fraud. Yeah. Now you still scaling the line.
Two places to live though.
Say that again.
I said you can't have 2 places that you live in. I mean, like if I'm at the house, let's say 4 days out of the week, and at my apartment 3 days out of the week.
Yes, I mean, look, what you're saying, we're both licensed, so we can't give you too much advice.
Yeah, I'm not trying to say too much.
I will say that so you do have I would say this: when you get a property, when you're about to move in, you have 60 days to move in, right? So 60 days and you have to move in. So if the first 2 months you're still in your apartment because you're renovating or taking time to move, once you use an FHA conventional owner occupied loan, you have to move in within the first 60 days. Now, after that, I'm sure there's someone that can give you a clear guideline on it, but I feel like it's pretty murky. The main thing they're going to be doing is they're going to be saying, are you living there? Meaning, is that your primary address on important documents? Are you receiving mail there? Like they could trick you and send a piece of mail there and you don't, and say like you need to respond in X amount of days. Like when they go to investigate you for mortgage fraud, they're not going to stop. So that's what I'm saying. Like, it's very important to make sure you're there. I can't give you the specific number, like if it's 51% or 61% or whatever. I can't give you that. I'll just say that you need to make sure you're at your property on a regular basis, and that you're using it on your documents. You're filing taxes. That's a big one, right? You're filing taxes with that address. So just don't commit mortgage fraud. But like theoretically, think about it. Like we can Airbnb our property out in DC for 90 days out of the year. So during those 90 days, that's my primary residence, but I'm Airbnb-ing it out, like, so, or maybe I travel. So it's no like specific, I don't know the specific line, but I just don't want them to flag you for mortgage fraud and to come after you.
Okay, thank you guys. I appreciate it.
Yeah. So we mentioned that with FHA, your minimum credit score is around a 580. I think you can go as low as 550 if you're putting down 10%. If you have a lower FHA, if you have a lower credit score, you may have to put down a higher down payment, but conventional is typically 620 or higher. I mean, is it 620? 620 or higher. Yeah, 620 or higher. If you have a high credit score, you can still use an FHA loan. If you live in PGC and buy multifamily in Baltimore, okay, we were talking about the 100-mile rule. Baltimore is less than 100 miles from PG County and DC. We already checked. We checked this in the Baltimore group. It will not qualify for the FHA 100-mile exemption or 100-mile rule. Steph, can you do pre-approvals or can only banks do it? So can mortgage brokers like you do pre-approval letters?
Most definitely.
Yep. That's why he's here.
And we actually typically move faster than your average bank, because a lot of times a regular bank turnaround can be a week. When you're working with brokers, I'm not going to say necessarily me, but how we operate is we try to get a response back to a client within 48 hours.
Yeah. So if you're in the pre-approval challenge portion and you're like, I need to get pre-approved by a lender because I want to know how much I can afford and I'm ready to start looking for a house within, how long do your pre-approvals last? Like
90 days.
Yeah, I want to start looking for a house within 90 days. Definitely reach out to Steph. I'm going to let me make that note, send lenders, send brokers info out. Email. Okay.
Hey, Tiana, are you taking down all these email addresses?
Yes, I am. I'm going through it right now, and I'll just probably CC you on this as well.
Yeah, because I just want to shoot out the link to the down payment assistance link that I have.
Please do. Yep, I'll do that. What
they qualify for.
Yep, I will definitely do that. You can use an FHA loan to buy a quad, which is a 4-unit, a 3-unit, or a 2-unit. We have the rules, the FHA loan requirement rules. Sorry, trying to get through all these questions and get these links. The exemption. What are your requirements for DSCR? So we already talked about that. It varies. It basically, DSCR is based on the deal. Is a real estate deal a good deal? I see a yahoo.fr. Is it supposed to be a something at yahoo.fr or is it supposed to be yahoo.com?
It is FR.
Oh, it is FR. Okay, cool.
Yes.
All right.
For France.
Oh, France, probably Francais.
Yeah.
That's all I know how to say. So no, parlez-vous anglais and parlez-vous français.
Parlez-vous français, c'est ça.
Awesome. All right, I'm getting some emails in here. Is it a year wait to house hack with the FHA? Okay, good question. Do you have to wait a year before you start house hacking? No, as long as you're going to live in the property, you can start house hacking immediately. Like when you move in, your tenant can move in with you. So you don't have to wait a year. You only have to wait a year to rent out the portion that you're living in because you still need to live there. But if you're house hacking, whether you're buying a single family house and rent out rooms, or you're buying a multifamily, living in one unit and rent out the others, you can rent those other ones out immediately. It's preferable, and that's actually what you should be doing. And then can you use the FHA to get a 3-unit? Okay, so the thing with the FHA is that when you're using an FHA again, you have to make sure it's not within 100 miles unless you meet one of those exceptions. So you can't use FHA for the next 5 years unless you're meeting the exceptions, like moving 100 miles every time. But you can do conventional 3% down or conventional 5% down. So I can use the FHA the first time, and then the next time I might use a conventional 5% down or conventional 3% down. And I can use a conventional over and over again every year for the next however many years until my lender is like, girl, you still in the same area. I need an explanation letter, because that's what she did to me.
So quick question. Can you hear me?
Yeah, I can hear you.
Tina, quick question. Can you hear me?
Mm-hmm.
So, Tiana, I'm so sorry.
Yes, okay.
So what I was trying to explain is like, so if I get and I get out, I leave and they do the refinance, I can make that 4-unit a conventional loan and then go back and do a FHA again. You can't do that?
You can do that. When you refinance, okay, so you cut off, but what I think you said is I'm using an FHA loan to buy a property. I'm going to refinance out of that FHA into a conventional loan so I can use this FHA loan again. You can do that because once you refinance, you don't have an FHA loan. However, you're paying closing costs. So you have to make sure it's worth it for you to do it. Because if not, it might be worth it just to pay the 5% of the next property, but because you don't want to keep paying closing costs if you don't have to. Now, if you get a lot of equity in it, then why not? So.
So you can't really house tag unless it's the 100-mile radius with the FHA.
You can house hack
without converting it over to a conventional.
Yeah, you're talking about growing. House hack means that you live in one unit or live in one portion of the property and rent out the others. That's house hack. Is a very general term. You're talking about growing your portfolio. So yes,
correct.
Grow your portfolio. The FHA, they're like, no, this is the owner occupied. Y'all investors, y'all doing too much. That's exactly what they're gonna say. All right. Conventional, they're gonna work with you a little bit more, right? Faye, you had a question about that?
Okay.
Oh, no,
you basically asked.
Okay.
Because I'm a government contractor, right? And I'm keenly aware of this Come Home Back to Africa campaign, where what we pay for real estate here for down payments, you can buy a beautiful home what they call back home in Africa, right? Because you get the whole thing for life. And you can even Airbnb. They just want us to come back home. I'll just put it like that. Bring our business entrepreneur acumen with us. But they want us to be having what they call a business connection, like all other groups have business connections back to different countries. And I was just saying that to say, is that something that you could recommend? And anybody can go to the website to look for yourself. I'm not making this up.
I can't recommend it because I've never done it. I'm only licensed in DC and Maryland, so.
Right, but like say for example in Kenya, in Kenya, they want to use their own currency. So they want to get a fusion of USD into their economy. And what you can get when you do that currency exchange, it would blow your mind.
Just the
South Africa, Kenya, and Ghana and Kenya. But I was just throwing that out there.
Yeah, you just need to consider regulations. Like we're federally regulated, so if things go bad, there's certain safeties that we have in place to go after those people, right? So I don't know if y'all heard, but like who's that? There's a radio host out in New York that's getting sued for some sort of real estate scam when he was collecting people's money for an investment.
You're talking about DJ Envy.
I didn't want to say his name, but yeah. So DJ Envy is getting
well, this is not a scam. Anybody can go to the website to those various countries and see for yourself and deal with the real estate.
Exactly. I see where you're coming from. You have to do your due diligence is the main thing. That you have to do your due diligence with any investment, but specifically when it's out of state or out of the country, make sure you do your due diligence. Someone said, is there a way we can get a list of foreclosures? So I'm a realtor. So when you guys reach out to me, I can set you up with an automated list of properties that meet your criteria. So if you're looking for properties only quads, I can set you up for that. Only quads under 500, I can set you up for that. if you're looking for foreclosures, there's a filter where I can just send you foreclosures. So all those, for the most part, I can set you up with. What's the percentage on hard money? It depends. My hard money last year was 9.5%, but I think my friend's hard money was 12%. I think this other guy's hard money was 14%. So it just really depends. And I'll also, hard money, it just has different lending terms. So keep that in mind. Sometimes they do require you to have a down payment, 20 or 25%, based upon your experience. Like if you flip houses before or you've been in real estate before, you may have a lower percentage as well. So, and then sometimes they will look at your credit if you want them to, in order to consider you for a lower amount. All right. Does DMV Assets have branches or partners on the East Coast? So with our multifamily movement, essentially there's different submarkets where people meet. Our DMV Assets group is really like almost a support group where we kind of talk about real estate investing and kind of figure out how we're going to get there, right? So a lot of people may not have owned a home, or you have owned a home, and we're really trying to help each other get there. So we've talked in the past about partnering to go in on bigger deals, but that requires a real estate attorney to draft up contracts and someone to really have the brains and know how to put together deals. So there's people with different skills. Some are more advanced investors and have multiple properties under their belt, and they're looking to partner, and some are brand new. They're like, I'm getting my FHA loan, this is going to be my first property, and I'm gonna work this strategy. So I would say it's a mixture of both, but some people are interested in it and some people are not. Best strategy based on the buyer scenario. Yeah, so Steph, if you're reaching out to your lender or broker, you tell them your scenario, they're going to try to find some sort of programs that work best for you based upon your scenario. In terms of crime, they said use Spot Crime. Spot Crime is a website that you can go to in order to figure out how much crime has happened. And I think you can filter by like last 30 days. It'll tell you whether it was armed robbery, car theft, stuff like that. What's the name?
Another way you can spot crime is, I don't know, everybody has his own camera, so you can put in a specific zip code that you're looking to potentially invest in and see what's actually going on in that neighborhood, because people are always posting on the Ring camera.
So the Ring camera app, what is it called? Neighborhoods, right? Or
yeah, yep.
Neighborhoods is the
you can change your zip code even if you got it set to your zip code. You can change the zip code to figure out what's going on in a specific area.
Yeah, like in this area, they still in Kias and Hondas. I'm gonna just let y'all know I'm in DC. Still in Kias and Hondas, period. So put a bar in your car. Also, when you said that for the out-of-state investor or everyone, use Google Maps, because Google Maps will give you a view of the neighborhood. If I see a property I like, I'll go on Google Maps and try to scan the neighborhood. If it's all boarded up houses, I don't even bother going to see it. So use Google Maps if you can't get out there right away. Even if you live in DC like me and you're commuting to Baltimore, I use Google Maps first. If you Airbnb your home more than 90 days, it cannot be considered your primary residence anymore. Okay, so Airbnb, these are rules and stuff. Let me know if you have to go, because I know I'm holding you much longer. I
don't see too many more questions.
Okay, perfect.
So we good.
So Airbnb regulations have short-term rental regulations. I won't just say Airbnb, that's just a platform. Short-term rental regulations have cracked down in DC and Maryland. DC's rule is that you cannot Airbnb your home more than 90 days, or what they consider short-term rental is basically less than 30 days, right? So if you're going to rent out a room in your house, you can rent that room out in your house that you're currently living in. So you still have to live in a part of your house for up to 90 days, but no more than 30 days at a time. So that person has to leave after 30 days and come back, or you have 3 different people, 1 month, 1 month, 1 month, or you can do 1 night here, 1 night there, whatever. In DC, that's a different rental license. You can also do the vacation rental license, where you're renting out your entire house up to 90 days in DC. It has to be owner occupied, and in DC, owner occupied means that you have filed your homestead tax exemption with the government. So you filed a homestead tax exemption, that's how they know that this is your primary residence. Maryland's a little bit different. Maryland cracked down on short-term rentals, but it differs by county. So I can't remember PG off the top of my head, but I remember Baltimore. Baltimore, if you're renting out the property for less than 91 days, so basically 90 days or less, you have to have, it has to be owner occupied. So that's why in Baltimore, I'm like, oh, I'm gonna do travel nurses is 91 days or more. It could be 90, but 91 days or more, because I can do that as a midterm rental. It's not short-term rental because I don't live there. So both of these, DC and Baltimore, are saying that you need to live in this property. That needs to be your primary residence if you're going to do short-term rentals. So think nightly rental up to 30 days, and in Baltimore, anything up to 90 days. All right.
So that means, I'm sorry. So the 90 days are cumulative. That means if you have
Correct.
okay, so for all over the year, it has to be no more than 90 days.
Correct.
In
DC. For DC.
In Baltimore. And what about Baltimore, please?
Baltimore is, they're looking at time frames together. So if it's owner occupied, you can do short-term rental for your property, right? So it's not about the 90 days. They're saying that if it's not owner occupied, then you have to rent that property out for at least 3 months or longer, because it's not owner occupied. So they don't even want you to rent a property out for less than 3 months if you're not going to live in the property. They're trying to fix this housing shortage. So if you're not going to live there, you buy an investment property, just think to yourself, if I'm not going to live there, that's not my primary residence in Baltimore, my leases need to start at 3 months or more.
I see.
Yeah.
Okay. Thank you.
You're welcome.
I see one more question, Tiana.
Okay. Go ahead.
And I think the question is, what is the DTI ratio for FHA, conventional, and 203K, etc.? So the maximum DTI for a FHA loan, which I go to, is 57%. Now that's high, because that's pretty much saying that's 50%, 57% of your income can go towards debt. That's it. With conventional, 40 to 48%, depending on what your credit score is like. For 203K is the same thing as FHA, because that's a FHA product.
Okay. So, and then DTI, debt to income. So can we do a scenario really quickly? So if I'm looking at my debt to income ratio and I make $50,000 a year.
Okay.
All right. That
means,
let
me pull out my calculator.
Oh yeah, me too. $50,000 a year. Do you guys go by month or by year? Because I go by month.
We go by month.
Okay, good. All right. So divided by 12, $50,000 a year. I make $4,100 a year. I mean a month. $4,100 a month. That's my paycheck. So in order for me to afford a home based on a debt to income ratio, if I'm doing an FHA loan, 0.57, so 57% of this goes towards all of my debt. Or
so if I say the maximum DTI you can go to is 57%. So what I would do is multiply 0.57 by the monthly. So which was that?
4,100.
4,100. So divided by 12. So 50,000 divided by,
it was like 4,166, something like
4,166, right? So that's what you make on a monthly basis, gross, right? We just say we using gross figures. So what you would do is you would multiply that by 0.57. So what it's saying is your maximum payment, if you're making $50,000 a year, can be $2,300.
Okay, so that's my maximum.
Now, of course,
payment, or does that include student loans?
All debts, including everything. So
all debts, credit card debt, my student loans, all that, plus my mortgage can't be higher than $2,300.
It can't. It can't be. So that's the max right there for a person who's making $50,000 a year. And when we calculate income, we don't use after tax income. You know, we use the gross. So what you might put on your application is what you make each month. Typically will be higher because we're not going off what you get paid after taxes, but before taxes. You know, so, and also if you're receiving Social Security, then they typically allow us to gross it up, which pretty much means we're multiplying it by a figure to kind of add a little bit more to your income.
Yeah.
So I hope that kind of answered that question.
Yeah.
And like I said, again, the DTI also determines on the unique profile of the client. You might be short on assets. Your credit score might be low to mid. You might be trying to purchase a property at a certain price point. All this will go on to determine whether, you know, DU is the system that we use as lenders to underwrite to get an initial approval, right? So all that will be a determining factor to determine basically whether, we can get you at the maximum or, at the least.
So in order for me to qualify for more of a house, I need to pay down some of my debt. So if I have a car, and then what do I pay down my debt before or after my lender tells me to? Like if I have a car loan or student loans, do I go and deplete my savings to pay down my debt, or do I wait for my lender to say like, hey, I need you to do this?
Is that a question to me, or are you asking them?
It's a rhetorical question, but it's a question to you.
Okay. So keeping low debt is definitely important. If at a point you come to me and try to get pre-approved and you got high debt and you're able to pay down that debt because you have a significant amount of assets, then I would advise you to. But some debt, like a auto loan, if you got less than 10 payments left, then we're not even going to take that into consideration. Certain collections, we're not even going to take into consideration if they're even charged off or they're under like $2,000. They're not going to take that into consideration. They don't take utilities into consideration unless it's reported on your credit report. But yeah, I would say definitely have a conversation with your lender to determine what's the best route you can take as it pertains to you paying off certain debt. Because what that can do is by you paying off certain debt, then in turn, your credit score will go up and your lender can do what they call a rapid rescore to kind of capture the benefit of you paying off certain debt within a certain time frame. So now instead of using the initial score that we pull, we'll do a rapid rescore and use the new score based off the new information that's going to be on your credit report from paying down the debt.
Love that rapid rescore. So I typically advise my clients to talk to the lender first because I don't want them to deplete their savings that they would use for down payment or closing costs by paying down debt that they don't necessarily need to pay down in order to qualify for the property. So it's only if they like, oh yeah, they only qualify me for $300,000 and I really want this $600,000 property. And then I'm like, all right, well, you may have to get your debt to income ratio under wraps. But if you okay with the $300,000 property, let's use that cash towards your down payment or your closing costs, versus trying to pay down debt that they don't necessarily, I'm not gonna say don't care about, but it's not really affecting you significantly.
And another important thing is this. I want you guys to understand that when we take that in consideration, because a lot of people will come and be like, I want to pay off all my debt. I want to pay off my debt. It's not that we're taking, for instance, if you owe your credit card company $25,000, the $25,000 is not what's getting taken into consideration. It's the payment for that $25,000. So if you got to pay $500 a month to service $25,000 credit card bill, we're taking the $500 and not the total debt. You get what I'm saying? So it'll be payments from each loan, each trade line you got in your credit report, whether that be your auto loan that's $500 or a credit card you got to pay $400 a month, that's $900, or a personal loan that may be $100 a month, that's $1,000. So that $1,000 will pretty much go into your DTI. Okay.
Isabella, you had another question before we close out?
Yes, please. The first question is about the lender, seeing the lender before, like you said. So does that mean that I can see the lender even if I don't have if I don't find a house that I want to purchase yet? So I can just talk to the lender before that. Is that correct?
Yeah, so typically this is the pathway that we typically take. You guys get your finances in order. So get your credit score to at least the 580 for the FHA loan or 620 if you want to do conventional. That's what you do. So you get your finances together, make sure you have pay stubs, bank statements, or your tax returns, whatever. After that, you reach out to a realtor. Guess what? Your realtor is going to send you to a lender. So I'm going to send you to Stefan and say, I need you to get pre-approved before we actually leave out of our houses to go see a property. I need to make sure that you qualify for the properties that we see. My due diligence and my ethics as a realtor is to make sure that the people who I take into these other people's homes and these other people's properties can qualify for the property. And I'm not saying like, oh, you qualify for $490 and this was $500. I'm saying like, I need to make sure that you qualify to at least purchase. So you're going to talk to your lender and get pre-approved. That's really what I call my step one for my buyers, is to get pre-approved the second you're ready to purchase a home. So because your pre-approval letters are going to last for 90 days. So that is if you're doing the traditional method and you don't have a bunch of cash in your bank account that we didn't know about, that is essentially what you're going to do.
Okay, thank you. And so the other question was to come back on that Airbnb your house. So I live in a home and it's considered my primary residence. So you're saying that from the requirement from the bank, you cannot rent it for more than 90 days to
No,
Airbnb?
that's not a bank requirement. I'm not talking about anything regarding the lender or the bank or the government. Or the lender or the bank. I'm talking about your city or county rules. So I'm familiar with my city's rules, Washington, D.C., and I'm familiar with the areas where I invest in. So Baltimore. So they have their own regulations about how much you can Airbnb your property, how many days you can do it. Now that's going to change based upon what city, state, or county you're living in.
Okay, let's say I live in Baltimore.
Mm-hmm.
And
city or county?
City, Baltimore City, yes. Right. Okay, so and I live in the apartment. Mm-hmm. So it means that from the requirement of the city of Baltimore, I can Airbnb that place no more than 90. No, it's my primary residence, exactly.
No, you can Airbnb it up to 365 days. They're saying that if you live in the property, there aren't really as many restrictions on Airbnb your property, other than that you register it as an Airbnb. Now, if you do not live in that property, that's an investment property, then when you rent that property out, the renter has to rent for at least 3 months or more. So we're creating more mid to longer term rentals. So in Baltimore City, if I live in the property, I can Airbnb it, so I can rent the property out for 1 night, for 2 nights, for a week, for 30 days, for 60 days, for 90 days, it doesn't matter. But if I do not live in that property in Baltimore City, I cannot rent a property out for just 2 weeks. I can't rent a property out for just 1 night. I can't rent a property out for 88 days. That lease has to be at least 90 days or more because of the restrictions.
So in fact, if I live in the property, I don't have restriction basically for Airbnb.
Exactly. Not one that I've read about in Baltimore City.
Thank you. Yes, that's my concern actually. Thank you so much.
Now, the other thing you said is you live in an apartment. Now, if your apartment has different regulations, you need to talk to the apartment and or a condo board and or HOA. That's a whole different story.
Oh, no, I don't have a restriction on that. Yes, okay. I can Airbnb it. Yes, thank you.
All right, and we're going to do this last question, y'all, because it's getting late. And this talks about getting multiple pre-approval letters from different lenders. Is it safe to get multiple pre-approvals from different lenders to see which one you can get the most from?
So I would say this.
Yes, it is. That's what Julian tells us to do.
Yeah,
it's definitely nothing wrong with shopping around, because that's what you're pretty much doing, shopping around for the best term or seeing if a lender is going to approve you for more than the next lender. So it's definitely nothing wrong with that. You want to make sure that you shop around within a specific period of time, typically like 2 weeks to a month. So all them inquiries that's going to be generated from all the lenders pulling your credit is not going to affect you individually, but as one.
Yep, exactly. So within a short period of time, if you're shopping around, it's not going to drop your credit score as much. But if you are shopping around all year long, then those different inquiries can drop your credit score. Also, the great thing about using a broker is that's essentially what the broker is doing. They're shopping around your files to different lenders. So you can go use a direct lender, or you can use a broker like Stefan, and he's going to take your application and shop around to different lenders to try to get you the best rates. But we're looking at these pre-approval letters. We want to know what interest rates are they offering us? Are they offering us any type of down payment assistance? Like, you're comparing them, whether they're closing costs. So you can definitely do that and look at that, but definitely feel free to also reach out to a broker who can do some of those things for you. All right, guys. So I'm so glad. Thanks, G, for telling me to get the picture early, because we did, and I'm glad we did. I'm going to stop this recording. I'm going to go ahead and send this information out, not today, but I will send it out